Hey guys! Tonight we're diving into something deceptively simple. Why tiny gains, those small, almost invisible steps you take every day, matter way more than you think. You probably won't survive this without hearing at least one awkward financial metaphor about turtles, snails, or maybe even ants, but here's the thing. Those tiny moves pile up quietly, relentlessly, and eventually they turn into mountains of wealth. It's like planting a seed and forgetting about it, only to come back years later and find a tree so tall it scrapes the clouds. So, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. Drop your location and local time in the comments so we can see where in the world this money talk is keeping you up at night. Now, dim the lights. Maybe turn on a fan for that soft background hum, and let's ease into tonight's journey together. You're standing at the foot of a mountain, not Everest. Just your financial mountain, and the peak seems impossibly far. But what if I told you that you don't need to sprint to the top? You don't need to make wild bets or strike gold overnight. Instead, each day you take a tiny, consistent step upward, like adding just a few dollars to savings, trimming an unnecessary expense, or learning one small piece of financial wisdom. Those steps, those tiny gains, add up. Think about it. The idea of small daily wins isn't new. It's baked into how some of the greatest successes throughout history happened. Take Benjamin Franklin, for example, a guy who famously said, "A penny saved is a penny earned." It sounds simple, almost boring, but Franklin was onto something. Those pennies piled up. His investments and savings habits grew steadily over time. Historians still argue whether Franklin's frugality alone made him wealthy, or if it was his relentless curiosity and inventiveness that tipped the scale. But the steady, incremental approach was a big part of the picture. Now, here's a quirky tidbit. Did you know that ancient Mesopotamians were probably the first to develop early compound interest concepts around 2000 BCE? They kept records of loans and interest accumulating over time, which suggests that even before modern banks, people understood that small gains, left to grow, could turn into big returns. They just didn't have the fancy calculators we do now. Instead, they used clay tablets and a lot of mental math. Imagine the patience. Small gains happen in moments so ordinary, you might overlook them entirely. Choosing to make coffee at home instead of splurging on that $5 latte. Or reading one page of a financial book each day instead of scrolling mindlessly on your phone. You might think, what difference can that make? But it's that mindset, the daily small win, that separates people who stumble on the financial ladder from those who climb steadily upward. And while we're on that, here's a gentle warning. The world around you is designed to steal those small wins. Advertisements, peer pressure, flashy lifestyles, they all conspire to make you think you need big leaps and giant risks to get ahead. But that's a myth. In fact, trying to sprint often trips you up, and that's where a lot of folks lose out. It's like trying to sprint up a staircase wearing roller skates, not exactly a recipe for success. Now, I know what you're thinking. Warren, are you really telling me that just saving a few bucks or making tiny changes every day can actually build wealth? Yes and no. Small gains alone aren't magical. They need to be consistent and sustained. Think of it like stacking dominoes. One domino falling knocks over the next, and the next, and soon you have a chain reaction much bigger than the initial push. Your small wins are those first dominoes. Here's where the real trick lies: consistency. The financial markets, your habits, your knowledge, they don't reward big bursts. They reward persistence. You may not see growth every single day. Some days feel like treading water. But over years, those tiny moves start to shift your financial position in ways that can surprise even the most seasoned investors. I always say, don't underestimate the power of what looks small and insignificant today. The compound effect is real, and it's as much a mental game as a numbers game. When you wake up every day and commit to making one small improvement, whether it's saving a little more, learning a new concept, or cutting back on a bad habit, you're building an invisible foundation. And just like a skyscraper, that foundation supports everything that comes next. Now, since we're talking about foundations, here's a fun side note. There's this little-known fact about the Great Wall of China. Historians still argue whether the wall's actual military effectiveness was as big as its symbolic power. But one thing's clear, it was built brick by brick. Over centuries, no one handed the builders a giant block to lay all at once. Wealth building is like that, no grand gestures, just many small bricks stacked patiently. By now, you're probably feeling the weight of it. Like this idea of small gains is so simple, it almost feels like a trick. But that's the beauty and the challenge. Your brain craves instant gratification, flashy headlines, the promise of overnight success. But wealth, real wealth, is a slow dance with time. You learn to enjoy the rhythm, the small steps, and the subtle growth, because that's where real power lives. And here's a little secret. The people who master small gains learn to ignore the noise, the endless hot stock tips and get rich quick headlines. They're distractions. Instead, you focus on your tiny wins, your habit of setting aside a bit more each month, your curiosity to learn, your commitment to improve, even if it's just a sliver every day. Remember that crocodile dung sunscreen I mentioned once? The weird and wild ideas that seem big but flop. Small gains are the opposite. They're boring. Sure, but they build a fortress over time. It's not flashy, but it works. So tonight, as you listen, start thinking about your own tiny gains. What small steps have you been neglecting? What habits can you build, even if just a little, that could change your financial future? Because here's the kicker. Small wins aren't just about money. They build your confidence, your mindset, and your resilience. They prepare you for bigger wins when those come. That's the power of small gains. They turn the invisible into the inevitable, and the seemingly insignificant into unstoppable momentum. You just have to start and keep going. You keep climbing. But now the mountain's face looks a little different, slower, steadier, more deliberate. The second truth about small gains is that patience beats speed. You've heard the turtle and the hare story, right? Yeah? That old chestnut where the slow, steady turtle somehow outwits the speedy but careless hare. Turns out, in the game of building wealth, the turtle's the real MVP. Think about the stock market's history. Over the long haul, steady compounding growth tends to blow away wild, reckless bets. In fact, the average annual return of the S&P 500 over the last century is roughly 10%, which might not sound like fireworks. But when you let that 10% simmer for decades, magic happens. Historians still argue whether the roaring stock market of the 1920s or the tech boom of the late 1990s had more lasting impact on wealth creation. But the lesson remains. Volatility is a speed bump, not a roadmap. Funny thing about speed, humans are wired to want it. Instant gratification, fast results, flash-in-the-pan wins. They all light up your brain's reward circuits like fireworks on New Year's Eve. But wealth? Wealth is a slow cooker meal, not a microwave snack. You can't rush the flavor. It needs time to develop. I tell people all the time, impatience is the enemy of growth. Here's a quirky nugget. Did you know that the phrase slow and steady wins the race traces back to Aesop's fables? From ancient Greece, it's been reminding us for thousands of years that rushing doesn't pay off. Yet, despite the wisdom of old storytellers, investors still get caught up chasing the next big thing, the hot tip, or the latest craze. Speaking of crazes, remember the dot-com bubble? Back in the late 90s, everyone wanted a piece of internet stocks. The market was soaring at breakneck speed. It looked like a rocket ship blasting off. But the bubble burst, and many lost their shirts overnight. Meanwhile, the investors who stuck to their steady, diversified portfolios kept climbing the mountain, albeit at a slower pace. Patience also means weathering the storms. The Great Depression of the 1930s stands as one of the most brutal financial collapses in history. Yet, those who held on, who didn't panic sell, eventually saw their portfolios recover and thrive. Historians still argue whether government intervention or sheer human resilience saved the economy. Whatever the case, it was patience that rebuilt fortunes. But here's a fun twist. Some of the greatest market gains happen in just a handful of days. For example, many of the best one-day gains in history came right after major crashes. It's like a roller coaster that plunges and then shoots back up with a burst of adrenaline. If you blink, you miss it. That's why trying to time the market rarely works. You'd have to be psychic and patient at the same time, which is a rare combo. Your brain, ever the impatient beast, will try to trick you into selling during downturns or chasing fads during peaks. It's wired to fear losses more than it values gains. That's why slow and steady wins, because it forces you to outsmart your own instincts. Hold your ground and trust the long game. Now, imagine you're sailing across the Atlantic. You don't speed to the destination. You adjust your sails, account for the wind and currents, and keep a steady course. Wealth building is the same. Fast moves might blow you off course or sink your ship. The patient sailor reaches shore safely and richer. Remember that crocodile dung sunscreen we joked about last time? The rash of hot investment products promising lightning-fast riches are financial sunburns waiting to happen. They're flashy, they're tempting, but in the end, patience outperforms hype every time. So, the takeaway: you don't need to hustle like it's a sprint. Think marathon? Think ultramarathon. Embrace the steady grind and let time do the heavy lifting. Patience isn't just a virtue, it's the cornerstone of financial success. And the best part, patience requires no special skills, no insider tips, just time and your willingness to keep going. Even when the path looks slow, you may feel the urge to sprint, but hold back. Keep stepping, keep stacking your gains, keep reinvesting. Because when the dust settles, it's the slow and steady who stand tallest on the summit. You're moving steadily, now understanding that slow and steady wins the wealth race. But there's a secret sauce that powers those small gains, the magic of compounding interest. Picture it like a snowball rolling down a hill, starting tiny but picking up more snow. Momentum and speed as it tumbles along. That's compounding, and it's one of the most powerful forces in finance and life. The principle is straightforward. You earn interest not only on your original investment, but also on the interest it has previously earned. This means your money grows exponentially, not just linearly. Albert Einstein supposedly called compound interest the eighth wonder of the world. Though historians still argue whether he actually said it or if it's just a clever marketing line bankers love to toss around. Regardless, it's true. Here's a quirky fact. The Roman Empire's engineers used compound interest calculations to manage taxes and loans thousands of years ago. They didn't have calculators or spreadsheets, just basic arithmetic and a sharp eye for numbers. That's ancient wisdom doing the heavy lifting for modern investors. Let's break it down with a simple example. Imagine you invest $1.00 at a 7% annual return. After the first year, you earn $70 in interest. Now, in year 2, you earn interest not just on your initial $1.00, but also on the $70 interest from year 1. So, you earn slightly more in year 2. As the years go by, that interest on interest effect snowballs. The catch? Time is the crucial ingredient. The earlier you start, the more powerful compounding becomes. Delaying even a few years means missing out on decades of growth. Think of it like planting an oak tree. You could plant it today and watch it grow slowly over 20 years. Or wait until you're 50 and expect a fully grown tree overnight. Spoiler alert, the latter doesn't work. Did you know that Benjamin Franklin, that old penny-saving sage, started investing his inheritance in compound interest accounts? He even wrote about it in his letters, encouraging young people to start early. Historians still argue whether Franklin's success was luck, timing, or just smart saving. But compounding definitely played a starring role. Here's a quirky side note. Some investors call compounding the snowball effect, popularized by Warren Buffett, who started investing as a teenager and has famously let his investments grow for decades. The legend goes that his initial $100 investment has grown into billions, thanks to patient compounding and smart choices. But compounding isn't just for money. It works in knowledge, habits, and relationships too. Reading just 10 pages a day, learning a small new skill, or making tiny improvements in your health compound over years to create massive changes. The principle is universal small. Consistent actions pile up over time. Now, a word of caution. Compounding can work against you too. Credit card debt, for example, compounds just as quickly, often at high interest rates. Pay off debt quickly to avoid that snowball turning into an avalanche. It's like the dark side of the force. Compounding isn't inherently good or bad. It just magnifies whatever it touches. To get compounding to work in your favor, you have to reinvest earnings and resist the urge to cash out. Even small withdrawals interrupt the growth process. Patience is key. Watch your money grow silently in the background like an invisible garden. And here's a fun tidbit. In 1714, the British government offered a prize for anyone who could calculate compound interest accurately, a problem so complex at the time it required inventing new math techniques. Historians still argue whether this challenge accelerated financial math development, but it highlights how valuable understanding compounding was and still is. So as you move forward, remember, compounding is your most faithful ally, silently building your wealth like a tireless architect. The best time to start was yesterday. The second best time is now. You've gotten cozy with patience and compounding, but now it's time to pull back the curtain on something a lot less glamorous. The get-rich-quick traps. The siren call of overnight fortune, the promise of fast money, easy wins, and dreams turned real with a few clicks or a lucky break. It's like financial junk food tastes great but leaves you broke and regretting it the next day. You probably know the story. Pyramid schemes, multi-level marketing that feels like a cult, cryptocurrency scams, and too-good-to-be-true investment pitches. Despite countless warnings and headlines about people losing millions, the allure of quick cash remains irresistibly seductive. Humans have always chased shortcuts, but history shows that most shortcuts lead to dead ends or worse. Here's a historical gem. In the 1920s, the stock market frenzy was fueled by margin-buying people borrowing money to invest wildly. It looked like easy money until the crash of 1929 wiped out fortunes overnight. Historians still argue whether the crash was caused by speculation, economic imbalances, or bad policy, but the lesson was clear: fast money can disappear just as fast. Now, here's a quirky fact. In the 18th century, the South Sea bubble captivated England with promises of vast riches from trading rights in South America. Investors poured money in, prices skyrocketed. Then the bubble burst spectacularly. This episode became so famous that it inspired Jonathan Swift's satirical Gulliver's Travels. Seems like satire and financial disaster have been best friends for centuries. What makes get-rich-quick traps so effective? They tap into deep psychological urges, the fear of missing out, the desire for immediate reward, and the hope that your luck will outshine everyone else's. But these traps aren't just scams, they're lessons in disguise. The moment you realize there's no free lunch, you're closer to true wealth. If you want to build wealth, your best defense against these traps is skepticism paired with patience. Ask questions. Research. If it sounds too good to be true, it probably is. Remember the old saying, easy come, easy go. Those flashy promises are often built on sand, not stone. But don't mistake caution for cowardice. Taking calculated risks is part of the game. But there's a big difference between calculated and desperate. The latter usually leads to painful losses. I've seen people throw everything at speculative ventures and lose their life savings. They came back wiser, but at a high cost. A quirky side note: in 2008, during the financial crisis, there was a brief surge of investment opportunities promising to ride the recovery wave. Many were frauds or heavily risky bets disguised as sure things. The phrase pump and dump entered mainstream consciousness, describing schemes where insiders artificially inflate prices before cashing out, leaving others holding the bag. Historians still argue whether the dot-com crash or the 2008 financial meltdown caused more lasting damage to investor confidence. What's clear is that greed and impatience have fueled these cycles repeatedly. So, how do you avoid these traps? Focus on building real value slowly, rely on proven principles, and remember that your greatest asset is time. Protect your capital, diversify sensibly, and don't chase hype. When you feel that itch for a shortcut, remind yourself, wealth is a marathon, not a sprint. You might chuckle at how often people fall for these traps despite centuries of warnings. But that's human nature: impatient, hopeful, and occasionally reckless. The bright side: every stumble is a chance to learn, and those who learn fast end up stronger. Keep your eyes open and your patience sharp, because the slow, steady climb is where real wealth lives, and it's a much nicer place than the roller coaster of get-rich-quick schemes. You've dodged the flashy traps and embraced the slow, steady path. Now, let's talk about your secret weapon: reinvesting dividends and earnings. Picture this as the financial equivalent of a snowball, not just rolling down a hill, but picking up not only snow, but also leaves, twigs, and little bits of gold along the way. Reinvestment is where your money goes back to work, and instead of taking a paycheck, it buys more bricks for your wealth fortress. Dividends, in particular, are like surprise gifts companies send shareholders, usually in cash or additional shares. Instead of spending those gifts, reinvesting them means you buy more shares, which then generate their own dividends. This feedback loop can supercharge your portfolio without needing to add more cash out of pocket. The most famous dividend reinvestor of all time. Yours truly. I didn't just buy companies, I let my earnings buy more companies. Historically, some companies have paid dividends consistently for over a century. Take Procter & Gamble, which has paid uninterrupted dividends since the 1890s. Through wars, depressions, and recessions, historians still argue whether such longevity is a marker of a company's strength or just luck and timing. But for investors, these steady payers have been a cornerstone of long-term wealth building. Here's a quirky fact. In the early 20th century, some railroad companies paid dividends in the form of free train rides or discounted travel because cash was tight. Imagine getting your dividend in tickets kind of like receiving an unexpected upgrade on your trip home. Not exactly the cash you could spend on groceries, but hey, it was something. Reinvestment isn't limited to dividends, either. Profits from side gigs, rental income, or any earnings you generate can be reinvested into your main money-making engine. The principle is the same rather than enjoying every dollar immediately. You channel those earnings back into building more earning potential. One pitfall, though, is being tempted to cash out those dividends or profits for short-term pleasures. It's like having a magic bean that grows a money tree, but deciding to eat the bean instead of planting it. The snowball shrinks instead of grows. Patience here is doubly rewarded. By reinvesting consistently, you harness the power of exponential growth. The math is so compelling that even modest reinvestment rates can lead to surprisingly large wealth down the road. It's the slow, compounding power of making your money make money. Speaking of reinvestment quirks, in 17th century Amsterdam, the birth of stock exchanges saw investors reinvesting their dividends so zealously that some companies ended up with a shareholder base too diversified to effectively govern. Historians still debate how this influenced modern corporate governance structures, but it's a fascinating example of reinvestment's power and potential pitfalls. And here's a little secret from my own playbook. I'm obsessive about letting earnings roll back into investments. It's boring, it's slow, and it's the exact opposite of glamour. But over time, it has built companies and fortunes that defy expectations. So next time you see a dividend check or cash in your account from earnings, resist the urge to splurge. Instead, imagine that money planting another seed, one that will grow, bloom, and bear fruit many times over. Your secret weapon isn't a fancy strategy, it's discipline, consistency, and the quiet art of reinvestment. Remember that crocodile dung sunscreen? Well, reinvestment is like sunscreen made from the purest ingredients. Simple, effective, and protective against the burns of impatience. Keep feeding your snowball and watch your wealth grow quietly, steadily, and powerfully. You're now wielding the power of reinvestment like a true financial craftsman. But wealth doesn't build itself in a vacuum. Learning from history's greatest investors is the next crucial step on this journey. There's a reason why legends like Benjamin Graham, Peter Lynch, and yes, myself, have become household names in investing circles. We didn't just stumble into success. We studied, learned, and adapted. Take Benjamin Graham, often called the father of value investing. He taught the world to look beyond hype and price volatility to find real value in businesses. Graham's classic book, The Intelligent Investor, has been read and revered by generations of investors. Historians still argue whether Graham's principles apply universally in today's tech-driven markets or if the world has moved too fast for old-school value strategies to keep pace. Still, his lessons about patience, analysis, and discipline remain foundational. Now here's a quirky tidbit. Benjamin Graham reportedly enjoyed taking baths in a bathtub filled with cold water to clear his mind before making big investment decisions. Whether this helped him or just kept him awake is up for debate. But it sure shows that even the greatest minds have their eccentric rituals. And then there's Peter Lynch, who famously managed the Fidelity Magellan Fund from 1977 to 1990, delivering average annual returns of nearly 29%. Lynch's mantra was to invest in what you know, encouraging everyday investors to use their personal knowledge to spot opportunities. His approach made investing more accessible, But it also sparked debates on whether this strategy risks overconfidence in familiar industries. Funny fact, Lynch once bought shares in a bicycle manufacturer because he liked the brand's bikes, only to sell them later after noticing the company had problems he hadn't spotted from personal experience. It's a reminder that even great investors learn from mistakes. Of course, you know my own story. I started investing in stocks as a kid, buying my first shares in a company at the age of 11. Over decades, I focused on buying great businesses at reasonable prices, holding them for the long term, and reinvesting earnings wisely. But what you might not know is that I've had my share of blunders buying companies that didn't pan out, or underestimating technological shifts. The key was to learn from those errors, stay humble, and stick to proven principles. Historians still argue about the best investment style: value, growth, or a mix, but the common thread among great investors is a deep commitment to research, patience, and discipline. They don't chase trends or jump on bandwagons. They focus on fundamentals and long-term results. Here's another quirky note. Warren Buffett, often nicknamed the Oracle of Omaha, once said he likes to invest in businesses that even a crazed monkey could run. It's a humorous way to say he values simplicity and predictability in investments qualities that stand the test of time. Learning from the greats means also studying their mistakes and quirks. They remind us that no one is perfect, and that success is a marathon, not a sprint. They teach you to be cautious but not fearful, optimistic but grounded. So as you build your wealth, keep an eye on history's financial heroes, not to imitate blindly, but to absorb the wisdom, the failures, and the strategies that have stood the test of time. They are the guiding stars on your slow, steady climb. Remember, every great investor was once a beginner, fumbling with their first tiny gains. You're on the same path. You've absorbed lessons from the legends. But now it's time to zero in on the small daily habits that truly build financial health. Wealth isn't just about big moves or lucky breaks. It's a quiet, steady accumulation of good habits. Those tiny, seemingly insignificant actions that your future self will thank you for endlessly. Consider the simple act of budgeting, not the kind where you spend hours calculating every penny until you're ready to scream, but a gentle awareness of where your money goes. Tracking your expenses, even just for a week, can reveal surprising leaks. Maybe it's that extra streaming subscription you forgot to cancel, or the impulse coffee run. Historians still argue whether budgeting practices truly originated with early Babylonian merchants, or if they were more widespread. But what's undeniable is that awareness of spending has been crucial since ancient times. Here's a quirky tidbit. The ancient Egyptians reportedly used ostrich eggs as currency for small transactions. Imagine budgeting with eggs. It's a reminder that whatever your system, the principle remains: know what you have, what you spend, and where you can save. Daily habits aren't limited to money management. Your mindset plays a huge role. Small habits like reading financial news or books for 10 minutes a day, listening to podcasts during your commute, or following trusted financial educators on social media can build your financial IQ over time. Information compounds like money, feeding your ability to make better decisions. Remember that time when you learned about crocodile dung sunscreen? It was an odd, amusing fact, but it also underscored the importance of questioning assumptions and seeking reliable knowledge, an essential habit for investors navigating a sea of misinformation. Spending habits matter too. Developing the discipline to pause before purchasing, that split-second delay, can save you from impulse buys. This tiny habit often saves hundreds or thousands annually. Think of it as financial mindfulness, where you become aware of your impulses and gently steer yourself back to reason. Another small habit: automating your savings. Set up automatic transfers so that money moves to your investment or savings account before you even see it. Out of sight, out of mind, and growing all the while. This is like setting your financial autopilot on cruise control. On the health front, habits like getting enough sleep, regular exercise, and stress management indirectly influence your financial well-being. When you feel better physically and mentally, you make smarter decisions. Ever tried investing while exhausted or anxious? It's a recipe for rash choices. Here's an intriguing historical snippet. In Renaissance Florence, wealthy merchants kept daily ledgers not just of money, but also of personal habits and moods, believing that self-awareness improved both business and life. Historians still debate how widespread this practice was, but it's clear that financial and personal health have long been intertwined. You see, building financial health is holistic. It's not just numbers, it's mindset, discipline, and lifestyle. The small, consistent actions you take every day, checking your balances, reading a chapter on investing, delaying a purchase, each one quietly stacks up. So, as you trudge forward on your wealth journey, focus on these small habits. They don't scream success, but they whisper it, steadily and powerfully. Over time, they become automatic, part of your identity, and before you know it, you're living proof that small gains daily build big wealth over years. As you get deeper into the rhythm of small daily wins, there's an invisible battle raging inside your head, the fight against impatience and instant gratification. This section is all about the psychology behind delayed gratification, the mental muscle you need to develop to enjoy the slow but steady climb toward wealth. You know that feeling, the urge to buy that shiny gadget, splurge on a night out, or pull your investments out the minute the market dips. That's your brain craving immediate reward, firing off dopamine signals like a slot machine promising instant pleasure. But wealth doesn't play by those rules. It demands patience, delayed satisfaction, and faith in the process, even when you don't see immediate results. Back in 1972, a famous psychological experiment known as the marshmallow test was conducted at Stanford. Kids were offered a choice: one marshmallow now, or two if they waited 15 minutes. Those who waited tended to have better life outcomes decades later, better academic success, higher income, and even healthier lifestyles. Historians still argue whether the test measures pure self-control or other underlying factors like trust and environment. But it's a strong symbol of delayed gratification's importance. Here's a quirky fact. Some cultures practice delayed feast rituals, where communities fast or abstain from pleasures to build anticipation and appreciation. It's like training your brain to savor the reward later, amplifying the joy when it finally arrives. Wealth building works the same way. Waiting makes the eventual success sweeter. Your brain, however, evolved in environments where immediate rewards were often necessary for survival. It's wired for quick wins, finding food, avoiding danger, reproducing. So, resisting instant gratification goes against millions of years of programming. But the modern world demands different skills. You have to rewire your brain to enjoy slow, steady growth rather than instant thrills. There are practical tricks to help: mindfulness meditation, setting clear financial goals, and creating visual reminders of what you're working toward. When temptation strikes, these tools act like mental checkpoints, slowing you down and giving you space to choose the long-term reward. Remember that crocodile dung sunscreen. It's a weird example of how human ingenuity and patience can turn odd things into useful solutions. Similarly, training your brain to delay gratification isn't natural, but it's incredibly powerful when mastered. Another fun fact: in ancient Japan, the art of kintsugi involves repairing broken pottery with gold lacquer, celebrating the beauty of patience and imperfection. It's a reminder that waiting and nurturing, whether a broken pot or your wealth, can create something more valuable than before. Scholars still debate the best methods to cultivate delayed gratification, but most agree that awareness and practice are key. Like any muscle, your patience grows stronger with use. The longer you resist impulse spending or rash decisions, the more your future wealth will thank you. So as you move forward, train your brain to savor the journey, not just the destination. Embrace the slow drip of gains, the small wins, and the quiet compounding. Your future self is building a fortress, brick by brick, and every act of delayed gratification is another stone in the wall. You've learned to be patient, but patience alone won't cut it if you don't know how to manage risk. Risk management is like the guardrail on your financial mountain road. It doesn't make the climb easier, but it keeps you from tumbling off the cliff when the path gets rocky. Tiny losses, if unchecked, can destroy all the gains you've painstakingly built. Let's start with a historical fact. During the tulip mania of the 1630s, Dutch investors drove tulip bulb prices to absurd heights before the market collapsed, wiping out fortunes. Historians still argue whether this was the first speculative bubble or just a unique cultural phenomenon. But it's a perfect example of how unchecked risk leads to disaster. Now, the quirky tidbit. Some tulip bulbs were so prized that they were reportedly traded for houses or even entire estates. Imagine giving up your home for a flower bulb. Talk about putting all your petals in one basket. The key to managing risk is understanding that losses are inevitable, but catastrophic losses are avoidable. Small, frequent losses chip away at your capital and morale. If you lose 20%, you need to earn 25% just to break even. That's the cruel math of losses. Diversification, setting stop-loss orders, and avoiding emotional decisions are your main defenses. Diversification spreads your investments across different assets, so one bad apple doesn't spoil the whole barrel. Stop-loss orders automatically sell assets when they drop to a certain price, limiting your downside. Emotional decisions, like panic selling, often exacerbate losses. Your brain's fight-or-flight response kicks in, overriding reason. A quirky historical example. During the Great Depression, some investors held on to blue-chip stocks, believing in their resilience, while others panic-sold everything. Those who stayed calm and managed risk preserved capital and eventually recovered. Historians still argue the best strategies for risk management, especially in volatile markets. Some advocate aggressive hedging, others for simple, broad diversification. The takeaway: know your tolerance and plan accordingly. Another interesting fact: Warren Buffett famously said, Rule no. 1. Never lose money. Rule no. 2. Never forget Rule no. Ding! It sounds simple, but it's a powerful reminder that preserving capital is as important as growing it. Risk management also means not over-leveraging. Borrowing can amplify gains, but also losses. Many investors have seen their small gains wiped out by one bad bet made with borrowed money. Managing risk means playing smart, not just bold. Remember that crocodile dung sunscreen analogy. Risk management is like applying sunscreen carefully, not too little, not too much to protect yourself without losing the sun's benefits. So, guard your gains as fiercely as you pursue growth. Protect your capital, set sensible limits, and avoid the temptation to chase high returns without regard for risk, because tiny losses, if ignored, can snowball into financial avalanches that wipe out years of small wins. Stay vigilant, keep your guardrails strong, and your financial mountain will stand tall through any storm. You've learned the importance of protecting your gains, and now it's time to explore a powerful, yet often overlooked, tool in your wealth-building arsenal: diversification. Imagine you're at a buffet. Would you fill your plate with just one dish, hoping it tastes perfect, or sample a bit of everything, ensuring a balanced meal? Diversification is that buffet strategy for your investments. It helps spread your risk and smooth out bumps along the way. Historically, one of the earliest recorded examples of diversification comes from ancient Mesopotamia, where merchants traded goods across different regions and products to protect themselves from local crop failures or market crashes. Historians still debate whether this was a conscious strategy or simply a necessity of trade, but it laid the groundwork for modern portfolio theory. Here's a quirky tidbit. During the Renaissance, some European aristocrats diversified their wealth by investing in art, land, spices, and early banking ventures, basically. The original multi-asset portfolios. One nobleman was known to own tulip bulbs, Italian paintings, and shares in a spice trading company all at once. Talk about spreading your bets. Diversification isn't just about holding many stocks, it's about mixing different types of assets: stocks, bonds, real estate, commodities, and sometimes alternative investments. Each behaves differently under economic conditions. When stocks slump, bonds might hold steady. When real estate slows, commodities might pick up. This balance reduces the risk of catastrophic losses. The magic lies in how these assets move independently or negatively correlate. When one dips, another may rise, cushioning your overall portfolio. But beware, some investors fall into the trap of over-diversification, owning so many assets that their gains get diluted. It's like trying to eat everything on the buffet sometimes. Less is more. Historically, the Great Depression provided a stern lesson on diversification. Investors who had all their money in a single sector or company were devastated, while those with diverse holdings fared better. Historians still debate the causes of the crash, but the protective power of diversification is undisputed. A quirky modern example. In 2020, as the COVID-19 pandemic hit markets worldwide, Technology stocks soared while travel and hospitality plummeted. Investors with a diversified portfolio balanced the downturns and upswings, avoiding total disaster. Cost matters too. Diversifying with low-cost index funds or ETFs has become a popular way to achieve broad market exposure without the headaches of picking individual stocks. Plus, it keeps fees down, which matters a lot over decades. Remember crocodile dung sunscreen. Just like you wouldn't rely on one bizarre remedy for all your sun protection, don't rely on a single investment to do all the heavy lifting. A well-diversified portfolio shields you against unexpected shocks and lets your small gains compound without being wiped out by sudden market swings. So, mix it up wisely. Spread your bets, know your limits, and keep the buffet balanced. It's not the flashiest move, but it's one of the smartest, and that steady balance is what helps your wealth mountain stand tall through storms and sunny days alike. You've got your investments diversified, but there's a sneaky set of villains eating away at your wealth quietly behind the scenes: fees, taxes, and inflation. These silent killers don't shout, but they can erode your hard-earned gains over time, like termites gnawing at the foundation of your financial house. Let's start with fees. Investment fees might seem small, maybe a fraction of a percent here, a tiny commission there, but they add up, especially over decades. The average mutual fund charges around 1% annually, but many index funds charge much less, sometimes as low as 0%. That difference sounds trivial until you realize over 30 years, high fees can slice off tens of thousands of dollars from your returns. Historians still argue whether the rise of passive investing was a response to outrageously high fees or a natural evolution of markets. But one thing's clear: lower fees mean more money in your pocket. Here's a quirky fact. In the 1800s, stockbrokers charged fixed fees per trade that were often so high that many investors limited their trading to once a month or less. Imagine that, waiting 30 days just to buy or sell a share. It's a reminder how much progress we've made, but also how fees still sneak in, disguised as management or service charges. Next, taxes, the other silent wealth drainer. Capital gains tax, dividend tax, and income tax can reduce your returns substantially. A well-planned strategy can minimize taxes, like using tax-advantaged accounts, think IRAs, 401ks, or harvesting losses to offset gains. Yet many investors overlook these opportunities, losing more than they have to. Historians still debate the impact of various tax reforms on wealth inequality, but the lesson for you is simple. Pay what you owe, but don't pay more than you have to. Inflation is the third culprit: a slow, relentless increase in prices that reduces your money's purchasing power over time. Even a modest 2% annual inflation rate means your $100 today buys only about $55 worth of goods in 30 years. Inflation is why parking your money under the mattress is a terrible idea. Investing with returns that beat inflation is your shield. A quirky example: during the hyperinflation in Weimar Germany in the 1920s, prices doubled every few days. People would rush to spend money immediately before it became worthless. Historians still argue about how some families lost fortunes overnight, while others managed to protect wealth through foreign assets or commodities. The combined effect of fees, taxes, and inflation can make or break your long-term returns. Imagine earning a 7% return, but paying 2% in fees, 1% in taxes, and losing 2% to inflation. That's effectively a 2% real return. It may not sound exciting, but even that small return, compounded over decades, builds wealth if you're disciplined. Remember crocodile dung sunscreen. Just like you wouldn't slather on a product that secretly damages your skin. Don't invest without understanding what's eating your returns. Know your fees, optimize your taxes, and keep an eye on inflation. In the end, controlling these silent killers is less about grand gestures and more about steady vigilance, reviewing statements, asking questions, and making smart choices. Because over the long climb, every little bit you save from fees, taxes, and inflation is another tiny gain pushing you closer to the summit. You're mindful of fees and taxes now, but there's a double-edged sword in the world of finance called leverage. Think of leverage as a lever duh that can boost your gains by using borrowed money. But just like in real life, a lever can also snap and hurt you badly if used carelessly. Smart borrowing can magnify your wealth-building efforts, but most folks overdo it and end up with spectacular failures. Here's a historical nugget. During the 1920s stock market boom, investors used margin trading, buying stocks with borrowed money to amplify returns. This leverage worked great until the crash of 1929, when margin calls forced frantic sell-offs, turning small losses into devastating ruin. Historians still argue whether margin trading should have been regulated earlier, but the lesson about the dangers of unchecked leverage remains crystal clear. Now for a quirky bit. In the 1700s, some European speculators borrowed so heavily to buy shares in companies like the South Sea Company that their debts exceeded their entire estates. The bubble burst, and many nobles lost fortunes, even their ancestral homes. They literally leveraged themselves into bankruptcy before the term was even popular. So why does leverage tempt us? It promises bigger returns with less capital up front. It's like putting your foot on the gas pedal while your hands are tied behind your back, thrilling but risky. Used properly, leverage can help you purchase real estate, invest in businesses, or grow your portfolio faster than cash alone would allow. But here's the rub. Leverage magnifies losses just as much as gains. A small dip in asset value when you're leveraged can wipe out your equity completely. Many people confuse leverage with a shortcut to wealth and end up getting wiped out by a single bad bet. Risk management is critical here. Never borrow more than you can afford to lose, and always have a margin of safety. Remember, even the best investors like me avoid heavy leverage because the downside risk is huge. Here's a modern quirky example. Some cryptocurrency traders borrowed massive amounts to speculate on volatile coins, only to get liquidated when prices dropped. The dramatic losses were headline news, serving as a cautionary tale for anyone tempted to leverage too much in fast-moving markets. Historians still debate the role of leverage in financial crises, but the consensus is clear: excessive borrowing has fueled many collapses. The best use of leverage is conservative, strategic, and with an exit plan. So, use leverage carefully. Think of it as a power tool, not a toy. When wielded wisely, it can speed your journey. When misused, it can cause catastrophic setbacks. Tiny gains become tiny losses overnight if you forget this lesson. Remember the crocodile dung sunscreen analogy. Leverage is like applying sunscreen with a sledgehammer. Not only does it waste your effort, but it also risks damage. Be precise, cautious, and smart. The slow, steady path to wealth respects leverage, but never becomes a slave to it. You've gotten a handle on leverage. But here's the big secret that many overlook. The best small gain investment you can make isn't stocks or real estate, it's yourself. Building wealth through knowledge and continuous learning is like planting an eternal seed that keeps sprouting new branches. The returns, incalculable. Historically, the Renaissance period was a massive leap forward. Thanks to people investing in education, arts, and sciences, the Medici family famously funded artists and thinkers, creating a ripple effect of innovation and wealth that transformed Europe. Historians still debate whether it was the patronage or the unique cultural moment that sparked the Renaissance. But there's no doubt investing in knowledge paid off handsomely. Here's a quirky tidbit. Leonardo da Vinci was not just a painter, but an inventor, anatomist, engineer, and writer. His lifelong curiosity and learning made him a wealth of ideas and influence centuries later. His notebooks are still studied today, a testament to the power of intellectual capital. Investing in yourself means more than formal education. It's reading books, attending seminars, learning new skills, and cultivating emotional intelligence. The more you know, the better your decisions, financial and otherwise. Knowledge compounds like money, and over time, it can lead to new income streams, better career opportunities, and smarter investments. I remember starting out by devouring annual reports and financial statements, not because I had to, but because I was curious. That curiosity led to better deals and wiser decisions. Knowledge turned into an advantage that money alone can't buy. You can think of your brain as a muscle. The more you train it, the stronger and more capable it becomes. The habits of continuous learning, curiosity, and critical thinking are your personal compounding interest. Here's a fun fact. The ancient Library of Alexandria was a treasure trove of knowledge, one of the greatest investments in human learning. Its destruction remains a poignant reminder of how fragile knowledge can be, but also how vital it is to preserve and build upon. Scholars still argue the best ways to learn and retain information. Some prefer immersive experiences, Others advocate for bite-sized daily learning like reading or podcasts. The key is consistency, matching your style, and making learning a lifelong habit. Don't forget that crocodile dung sunscreen lesson. Just because something looks weird or unconventional doesn't mean it's useless. Embrace diverse sources of knowledge. Stay curious and never stop growing. So invest in yourself. Read, learn, experiment, fail, and grow. The returns on this investment outpace almost everything else, and best of all, they compound beautifully over a lifetime. You're investing in yourself now, and that's fantastic. But let's not forget an important ingredient in the recipe for wealth: luck, timing, and humility. No matter how much knowledge, patience, or discipline you have, there's always an element of chance in the game. Understanding and respecting that can keep you grounded and ready for whatever life throws your way. Think about the rise of Bill Gates. He famously got early access to a computer at his school when very few had such a privilege. That early exposure helped him build Microsoft and change the world. Historians still argue whether his genius or his timing mattered more, but luck and timing played undeniable roles. Here's a quirky tidbit. Some researchers found that lottery winners tend to exhibit humility and gratitude more often than those who don't win. It's like they know their fortune was partly luck and not just merit. Luck can't be controlled, but you can increase your odds by being prepared, open, and adaptable. As the saying goes, luck is what happens when preparation meets opportunity. Your daily small gains, learning, saving, investing prepare you for that moment when luck knocks. Humility is your safety net. It keeps you from getting overconfident and reckless when things go well. Many financial downfalls happen when people forget they're not invincible. Humility helps you stick to your strategy. Listen to others and learn continuously. Historically, many wealthy empires and entrepreneurs fell because hubris blinded them to risks and changing circumstances. The Roman Empire's fall is a classic example, with historians debating whether arrogance or structural issues caused the collapse. Another fun fact: Warren Buffett is known for his folksy humility and admits mistakes openly. This attitude has kept him in the game longer than most and allowed him to learn and grow. So while you build your wealth, remember that fortune favors the prepared, but humility keeps you wise. Embrace luck when it comes. Learn from timing when it's off, and stay humble through it all. Remember the crocodile dung sunscreen. Luck is a weird ingredient you can't control, but humility is the protective layer that keeps you safe from its unpredictable effects. The climb is long, the path winding, but with luck, timing, and humility in your toolkit, you're better equipped to reach the summit and enjoy the view. Here you are at the edge of the journey, ready to tie together everything we've explored. Your personal wealth journey is less about chasing a shiny destination and more about embracing the process, the small gains, the daily habits, the patience, and the resilience that compound into freedom. Think of wealth not just as money, but as the peace of mind that comes from knowing you're in control of your life's trajectory. It's the quiet confidence that no matter what storms hit, you've built a foundation strong enough to stand. Historians still argue whether wealth is more about mindset or money, but it's safe to say the two are inseparable. Here's a quirky fact. In Japan, the concept of Kaizen means continuous improvement, tiny changes made consistently. It's a philosophy applied not just in business, but in everyday life. Wealth building is your Kaizen in action, a steady march toward something bigger. The beauty of focusing on process is that it shifts your perspective from outcome anxiety, will I ever be rich, to engagement, what small step can I take today? This shift reduces stress and builds momentum. When you focus on what you can control, you create a sense of agency that fuels persistence. Remember those crocodile dung sunscreen lessons? Wealth isn't about finding a magic bullet, but about sticking to simple, consistent practices even when the glamour wears off. It's about showing up every day, making tiny gains, and trusting that the sum is greater than its parts. Your journey won't be perfect. There will be setbacks, doubts, and distractions. But if you've internalized even a fraction of what we've discussed, patience, reinvestment, risk management, humility, you're far ahead of most. In the end, building wealth is deeply personal. Your goals, values, and circumstances shape your path. The key is to keep your eyes on the steady climb and celebrate each small victory along the way. So as you close your eyes tonight, imagine your future self stronger, wiser, and freer standing on a summit built from countless tiny gains. That image isn't a dream, it's a promise, made real by your daily choices. Now, dim the lights. Maybe turn on a fan for that soft background hum, and rest easy knowing you're on the right path. The mountain is yours to climb, one small step at a time. The journey of building wealth is not a sprint, but a gentle, steady climb. As the day winds down and the night embraces you, feel the quiet strength of each small decision you've made. Those tiny gains, though invisible now, are the seeds of your future abundance. They whisper promises of security, freedom, and peace. Allow yourself to relax into this process, knowing that growth often happens in the unseen moments, in the patience you practice, the knowledge you absorb, and the discipline you maintain. The mountain may seem vast, but with every slow, deliberate step, you draw closer to its peak. Let go of the pressure to rush or to compare your journey with others. Your path is unique, shaped by your values and dreams. Embrace the small victories as milestones that carry you forward. Tonight, as your thoughts soften and your body rests, carry with you the calm assurance that wealth is not just a number. It's a state of mind cultivated by persistence and care. Sleep well, knowing you're building something lasting, brick by brick, moment by moment.